Holy, I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Germany just declared an economic crisis. I'll show you what's going on in Germany and why what's plaguing their economy could send them plunging into a deep depression. And while most American investors believe that we're separate from the global economy, I'll show you why the oil markets are telling us that the U.S. economy is about to face the same issues as Germany, and why tens of thousands of American workers are likely to soon hit the unemployment line. And is the liquidity crisis getting worse? China's latest move says it is. Now let's head over to Bloomberg, where we picked today's story up with a headline as VW eyes closing 3 German factories in cost-cutting push. And it was only a matter of weeks ago that we heard from Volkswagen executives that said due to a decline in demand, they were looking to close 1 factory. Now we see they're looking to close 3. And we're hearing from the unions that they're in complete uproar, saying that their employer has completely failed them and this can't happen. And yet behind this move, there's actually one country that's plaguing Germany's economy. The challenge here is it's soon going to affect everybody's economy all over the world. As Volkswagen AG plans to close at least 3 factories in Germany as Europe's biggest automaker tries to slash expenses to become more competitive. And this is an issue of overcapacity. This is something that we've been warning about because demand fell all across the world, particularly as we noted that all the stimulus efforts started to dry up. We saw savings rates here in America plunge, and next thing we know, demand started to fall at a time when factories were just out producing what demand was. The issue here now is demand has dropped so much that we're going to see factories all over the world fail. And this is just beginning in Germany. Is it coming to America? Well, much sooner than you actually think. And proposals to fix the struggling namesake VW brand include a 10% wage cut and shrinking all remaining sites in Germany. Could you imagine if this happened in the United States? If factories told their workers, look, we don't have enough demand, so we're going to close some of our factories, we're going to cut a bunch of jobs, and we're going to cut your pay because we can't afford it. And this is a challenge because when you look at what's going on in China, they have a very big competitive advantage. They're a low-cost producer, and they've been flooding the global economy with cheap goods at a time, again, when demand is plunging, particularly for automobiles. And the risk here for not just jobs in Germany, but all over the world is huge. Because if you don't think there's suppliers here in America that send products over to Germany for vehicles, well, there are. And that means it's going to backflow all across the supply chain. But the issue, again, is if demand for automobiles is plunging, what else is about to come crumbling down that's going to affect labor markets all over the world? And VW's plan threatens tens of thousands of jobs in Germany. This is starvation, a weakening in installments. And yes, this is only the beginning, because as people hit the unemployment line, they naturally spend less. And the issue here for all of these workers is there are no other jobs. It's not like, well, VW's struggling, but BMW's doing well, or Mercedes is booming, so they can go laterally shift and pick up a job there. The issue for a lot of these factory workers is they have no other options here, and that's the danger sign. You want to understand why Germany's economy is about to plunge into a depression. It's because where the manufacturing base goes, the services sector follows. If tens of thousands of jobs are gone, well, it's game over for Germany and then the rest of the world. The cuts include freezing wages next year and in 2026, despite the fact that inflation is surging higher, and abolishing one-off payments for workers that have stayed with the automaker for 25 and 35 years in a push to get rid of them. She added that Porsche, also led by Bloom, terminated its production relationship and future model planning with the Osnabrück factory. And this is something we're going to see here happen in the United States as well, because the issue with Germany right now is mostly due to China. Because when China is feeling prosperous, well, their consumers love to buy German vehicles. But the challenge is China has kind of jumped ahead in technology and is producing some of the best electric vehicles in the world. But the issue, besides the fact that they're producing some fantastic vehicles, is demand in China is plunging, and that means demand for German vehicles is also dropping. But many people say, well, that's just too bad for Germany. It's not going to have any impact on the United States. But hang tight, because what's happening happening here, we're seeing force from American automobile manufacturers is demand is also going down. And why is that happening? Well, there's two reasons. One, we have baby boomers who retired, and they used to have about 2.5 vehicles per family. And what they're finding out is they only need about one, maybe 1.5 vehicles per family on average. And that means demand is dropping from a cohort that used to buy tons of vehicles. They loved automobiles. Now, what about, of course, the post-pandemic economy? We see this hybrid workforce, so this work from home, and that means, of course, if you're not driving and commuting every day, you're not putting miles on your vehicle, you're not wearing them out, you don't need to buy one that often, and that means what we're seeing in Germany right now for very different reasons is going to affect U.S. manufacturers. Just wait, it won't be long before we get an announcement that a U.S. manufacturer is going to shuttle a plant that's going to be outrage, of course, for U.S. workers. But again, what's starting in Germany is a big sign that global demand is plunging and it's soon going to spread to a lot of other companies. And we're not productive enough at our German locations. This is from the CEO of VW brand, noting that factory costs are 25 to 50% above the company's plans. And again, we come back to China. Everybody wants to get away from them. The fact of the matter is they can outproduce everybody else in the world and do it at a much better cost margin. And that's dangerous because when we see overall demand decrease, the natural thing for an employer to do is cut jobs. Here we can see the capacity utilization rate in blue. This is U.S. economic data against the unemployment rate, and we can see as factory capacity drops as a percentage here, what happens is exactly what's going on with VW. We're going to close plants. We're going to cut hours. We're going to lay off workers. And sure enough, you see the unemployment rate in red rise. While it's not an exact mirror relationship, you can see it's a very strong relationship between the two. And what we can see here in the U.S. is that capacity utilization is falling and the unemployment rate is rising. And yet many people believe that once the election is over, demand in the U.S. economy is coming back, that the unemployment rate is going to fall. But what we're seeing in Germany, what we're seeing in China is all indicating that global demand is falling and that U.S. manufacturers aren't immune to that, which to me says we're likely to see a further degradation in our manufacturing sector until we see exactly what's happening in Germany, and that is factory closures, and we see a lot of Americans hit the unemployment line. In my opinion, the election isn't going to change anything. And it's not limited just to Volkswagen, as Porsche, Mercedes pledged to cut costs after China's slump hits profits. And anytime you hear, of course, profits coming down and cost-cutting measures being enacted, well, that means that workers are going to hit the unemployment line. But if you're looking to make a big profit, well, check out our CTA Timer Pro. If you wondered how we nailed this 25% return on uranium, it's because we have the best data. We back-tested our entire report because we show you how to trade against the machines, and when the machines get in a deep short position and price moves against them, it flags on our report. But now for our subscribers, we just added a hot list, and this is a buy signal that's generated anytime a security has 3 or more back-tested results over any of the 4-day periods that show a 50% or greater chance of a positive return. Look, you want to put the probabilities in your favor when you're trading. Well, check out our CTA Timer Pro. Our dev team is going to soon have this available for our Momentum Timer Pro because you get the daily reports, you get the tradable signals. I go through every trade, give you my opinion on it. We have full back-tested data made available to you, and now as part of course the recommendations, we give you stop loss levels, full tracking of trades and returns, and a weekly update on your trades. It's fully duplicatable, and you get a 30-day free trial. Links in the description below. Start making money and put the probabilities in your favor, because something that doesn't have a lot of probability in its favor, well, that is the German manufacturing sector, as Mercedes' key gauge of profitability slid 4.7% in the third quarter, undershooting its minimum target of 8% and the lowest level since the car maker split from its truck business in late 2021. So we think for a minute, is it possible that the European Central Bank cutting rates is going to save the German manufacturing sector? Is that going to get Chinese consumers to buy more German vehicles, or perhaps American consumers to do so? And if you're thinking there's not a chance, you've got this right. Lowering interest rates isn't going to change the issue here. What we know, China's economy entering a recession, seeing deflation, liquidity crisis in the banking system, consumers not spending at all. Now we see it plaguing Germany's economy, which is facing tens of thousands of workers hitting the unemployment line from VW alone. And that doesn't count, of course, Mercedes, Audi, BMW, or any of the other German automakers that are now struggling as well. And that, of course, we already know that U.S. automobile manufacturers are facing issues, and with the double whammy between the work from home movement and boomers not needing as many vehicles, watch for the same things happening in Germany to come to U.S. shores in the very near future. Porsche's third quarter vehicle deliveries in China slumped to their lowest level of the decade, and in my opinion have no chance of recovery. While Porsche plans to slim down its dealer network in China to cut costs, that means of course more people losing their job. The company is also aiming to trim research and development costs, which means of course more people out of work. Mercedes didn't elaborate on where its cuts would fall, but they're coming. Both companies operate plants in Germany where labor and energy costs are relatively high, especially compared to China. They're also investing heavily in the electrification shift, all while producing both electric and combustion engine models like the Porsche 911 sports car. But the problem here with Germany is too little too late. They missed the trend, and now between the fact that they got behind the global trend of automobiles and we're seeing demand plummet as stimulus measures are gone and there's no demand from consumers, well, what we're going to see is Germany's entire manufacturing sector plunge into a depression, take the entire European Union down with it, and from there it's going to spread rapidly across the world. And here in the US, if we don't see things turn around very quickly for one manufacturer, you can imagine there's going to be thousands of Americans hitting the unemployment line in the weeks to come as Boeing launches a $19 billion share sale to thwart the downgrade, focusing more on keeping the liquidity solvent than it is ending the strike. As the company is on pace to use around $4 billion in cash during the fourth quarter, which would bring its free cash flow outflow to around $14 billion for the year. The plane maker expects to continue burning cash to the first half of next year as it restarts its airplane factories, including assembly lines for its cash cow 737 MAX jetliner. But the problem here is they haven't ended the strike yet, so they're raising cash by selling more stock. And I want you to be thinking, this is what a lot of companies are going to do, because Boeing was a prolific buyer of its stock. Back in the boom time, they took their cash and they bought their stock back. Now, as their stock is plunging, they're issuing more stock to raise cash because they have too much debt. And this is going to be something that companies do during the next recession. It's not going to be one or two, it's going to be a lot of them. And many people right now are relying on the U.S. equity market as a safety trade. What they don't realize is due to a decline in demand and all of the debt loads, companies are going to be faced to sell stock and continue to sell it all the way down. And Orberg is also considering options to streamline Boeing's broad portfolio. He's launched a review of its businesses that the CEO expects to conclude by year end. The company is weighing options for the future of its troubled Starliner space capsule program as part of the review. And that's, again, another factor of what you see when financial conditions tighten and demand drops as companies start to review across the board and make cuts. Because in boom times, you can afford to have some loss-leading projects or divisions. But again, during times when financial conditions get worse and demand plunges, you've got to make cuts, and every one of those cuts means another worker is out of a job. But does that mean, of course, that everything's going to be fine? Well, not exactly, because the energy markets right now are telling us the global economy is about to head into a recession. And here we can see from this article, oil craters as geopolitical jitters ease, but that's not the issue. Its demand is going down, because I want you to be thinking about the German auto manufacturing sector. I want you to think about the Chinese economy. I want you to be thinking about what's happening at Boeing and the broad slowdown in the U.S. economy. When that happens, demand for energy falls and price goes down. So when you see that happen, it's not a good thing. Now, many people will say, hey, lower energy prices is going to help consumers and maybe they'll spend more. And maybe they will. But if they don't, what oil prices plunging here is telling us the global economy is crashing and fast. And oil's down big overnight as the target scope of the attack and absence of immediate retaliation signaled that we've seen the markets are pricing out some of the geopolitical risk premium oil. And currently oil is trading in the massive 72 area again. We've dipped below on a few occasions, but these are make it or break it levels to watch, because if it breaks it, Well, what it suggests is demand from the global economy is about to plunge. But at the same time, we're seeing U.S. investors bet big on U.S. interest rates going higher. The link between oil says interest rates are about to come crashing down as financial conditions are tightening. And we see that oil and rates have moved in perfect tandem for a long time. And note the latest gap. Can both be right? The answer is no, they can't, because what oil is telling us is exactly what we're seeing in Germany. It's what we're seeing in China. It's what we're seeing in some U.S. auto manufacturers here is demand is plunging. And when that happens, oil prices go down. So how do you get demand to rise? Well, it's not through higher interest rates. It's through lower interest rates. And that, of course, all comes back to we see what's going on capacity utilization here. Is oil likely to go down? The answer is yes. As we now look at West Texas Intermediate against capacity utilization shown in blue, and we see as demand at the factory level goes down, well, crude oil prices go down. And you see that relationship in both recessions. But look what happened around 2015. Capacity utilization dip, and oil fell enough that it revived demand a bit. But look about going into the pandemic. You see the global economy was once again slowing, capacity utilization dropped, oil prices dropped. We're seeing that now, and this is a huge red flag, because what it means is that investors betting big on rising interest rates are about to be on the wrong side of the trade, particularly as we look to China, who is trying to plug a massive liquidity crisis. As we see, China's central bank has new policy tool to manage liquidity. The so-called reverse repo is a form of short-term borrowing used in money markets, which involve the purchase of a security with an agreement to sell it back at a specific date. Here, the securities will include sovereign bonds, local government notes, and corporate debts. So I want you to understand what's going on in China, because there is a liquidity crisis that Beijing's identified, and they need to borrow some money to get the economy going. So what they're going to do is they're going to issue a bunch of long-term government debt. Now, we know the banks are going to buy it because they don't want to lend, but China really doesn't want their banks buying it. And yet there's nothing they can do. So what's going to happen is liquidity is going to go out of the banks to buy these bonds, and then of course the banks are going to be sitting on this long-term debt. Then China said, wait a minute, we're going to come in and buy and do some sort of QE swap. We're going to buy that long-term debt off of you and put cash back into the banking system. I know this doesn't make a whole lot of sense, but then here's what they're saying is, wait a minute, we realize that the cash that you're going to have isn't going to generate that much interest because we're trying to cut interest rates. So we're going to let you swap that cash in overnight repo for collateral in the term. That's right, a bond, exactly, including sovereign bonds, local government notes, and corporate debt. If this makes any sense to you, please let me know, because the new tool is likely to provide longer-term liquidity injection to the interbank market and could help with an expected increase in bond issuance. At least that's what they're hoping is going to happen. They believe if they get this long-term debt out of the banking system by going through all these steps, that somehow the banks are going to be incentivized to lend. And that's not how it works. The banks are going to be incentivized to lend when the bad debt issue starts getting better and people start paying on their loans, when the economy turns around, and when incomes go up, and when there's more jobs created. It has nothing to do with all the swapping of debt and cash in the system. And yet the overnight repo has an underlying exchange of bonds, so banks can hopefully free up longer-term liquidity. Again, lots of steps to get these long-term bonds out of the banking system here that the banks actually want to hold on to, because they know that, of course, the real estate developers are insolvent. And if they're insolvent, it means it won't be long before the banks are insolvent as well. The PBOC can prepare banks to facilitate a rise in government bond issuance ahead. I don't know what the whole point of this is, other than it's a big shell game, because money market gauges have been flashing signs that China's banks and non-bank financial institutions remain under a degree of funding stress. And so this is how they're going to solve it, is by issuing a bunch of long-term debt that the banks are going to buy, and then they're going to come back and buy that long-term debt to put cash in the banking system, and then they think there's too much cash, so they're going to say, hey, you can come to reverse repo and you can swap it for debt that you can get back later on when you want to lend. And if you believe any of this is going to do anything, well, it's not. The institutions are heading into year-end that may see a seasonal rise in cash demand. We're also waiting to see how potential fiscal stimulus will be funded. So what we're seeing now is major problems in China, sending Germany's economy into a recession, if not outright depression. And if you think the U.S. economy is immune in any way, what you're about to see in the months to come, perhaps even sooner, that we're all in this together, and the problems in China, the problems in Germany will soon be the problems here. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye. Bye now.